Equity is often the most valuable monetary asset an individual owns, from the routine profit distributions you receive to the capital value of the stock. That's why we recommend going through a process of thorough discussions and financial modeling to ensure a deal works for both sides of the transaction prior to implementation. The most common way of transitioning equity is through a sale. These are usually done between two individuals, but may also involve entities. Whether we're helping you design a full-blown succession plan or starting with a sale of 5% to a key employee, there are deal terms which should always be considered. Who is selling to whom? How much equity should be transitioned and when? What is the interest rate and what is the payback term length? Two of the most important deal terms to establish as part of this process are the price and financing method. We often recommend having a valuation performed as a starting point in determining a fair price for the purchase. Pricing should consider if the buyer is in a minority position, lacking control, liquidity, and marketability, and if the purchase will be an all-cash deal or seller financed. In terms of financing, will this purchase be made through bank financing, seller financing, or a hybrid of both? If seller financing is used, should this be structured as a fixed payment note with a set payback schedule, or is the seller willing to allow the buyer to pay back the note out of future profits? Having a supporting financial model to view the various deal terms of current and future equity tranches within the framework of your company cash flow will show you what executing a deal means for buyer and seller in terms of yearly income and capital value. In some instances, it may make sense for an individual who has a valuable book and is a cultural fit to contribute their assets into the company in exchange for newly issued shares. Another equity transition strategy may be for the company to grant shares to key employees, though this is less common. With all of these equity transitions, tax and legal implications should always be considered. Sometimes, before equity is offered, we help you develop a path to partnership document outlining the parameters that make someone eligible for equity. These may include objective criteria, such as company tenure and amount of revenue serviced, or subjective criteria, such as being a cultural fit or a team player. This can be an effective tool to communicate expectations and motivate key employees. We're here to help you understand your options, map out the financial modeling to arrive at the deal terms, and present the plan as an objective third party. Once decisions have been made, our team of legal consultants will work with you to memorialize the plan.